Today, are property cycles predictable? Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest posts covering finance and property news with a distinctively Australian flavour. And today I'm joined by a very special guest who's deep in the property sector and has some really interesting views, which essentially says you can tell precisely what's going to happen ahead. Hello, Phil. Good to see you.
Yeah, hi, Martin. It's good to be here. It's a most auspicious day, the ending of the bull market.
It's a perfect day for having this conversation, right? Because essentially things are falling about our ears left, right and centre, although in fact REIA has just come out and said, don't panic, everything's fine, the property market will still survive. Now, you've written a book, and this book is really interesting and important, particularly now, because essentially your theory is that this is all very much predictable.
Well, let me say, I've got the book there. There it is, Secret Life of Real Estate and Banking. I did that a couple of years ago. It's a very simple premise. It's more than a theory. It runs more than theoretical, and it's just basically this: dealing firstly with we talk about asset markets, but let's talk firstly about the real estate sector. And my book has been about the United States first, primarily, obviously because it leads the markets. 14 years up, 4 down. It's as simple as that. I've traced that history back right to 1800 in the United States. It runs from the bottom of a real serious real estate-led recession or depression. It runs from there, from the bottom, 14 years up, and we get to the top. We get a peak, the extreme peak. Then land price turns over. Credit gets into trouble, banks get into trouble, and we then have the 4 years down. Now, listeners at the moment and viewers, if they can cast their mind back just a little bit, they'll have good memories probably of 2008 into 2012, thereabouts. And of course, the 14 years up before that ran from 1992 approximately. So that's the basic theoretical framework from which I judge everything. That 14 years up is punctured halfway through by what I call a mid-cycle slowdown. And we are right there now. And the difference, probably the most important difference I could highlight for your viewers, history shows that the mid-cycle slowdown, which is about 7 years from the low, and the lows are in 2012, 2019 were the tops now, the mid-cycle slowdown of the real estate market generally doesn't involve land value. And so I think you can probably see how that's turning out now. I'd be expecting that from where we are today, you'd get some good government procedures and interest rate cuts and various things like that to the governments. They certainly want to protect markets, and we'll just see how it goes from here. But that's real estate cycle like that. The mid cycle is different to the extremes, if that makes any sense.
Yeah. Okay. So 14 years and then 4 years down, and that's consistent in Australia as well as in the US.
Well, the Australian market's much smaller. From a worldwide perspective, not a lot happens in Australia, but Australia, historically speaking, generally has followed the United States about 6 to 12 months behind. So one of the things I thought to myself, obviously being based in Australia when I was doing all my investments and study and stuff, why would you want to study the US markets? Well, US markets lead everything. So I found out eventually that if you had a good guide as to what was going on in the US, Australia was about 6 to 12 months behind. So it gave you a good perspective as to what should happen in Australia next.
Right.
Yes.
So there are relatively similar patterns of 14 years, 4 years. It's just that it moves out a little bit because of the fact that we tend to follow the US.
Well, the research I did in the book was US based.
Okay.
And the United States has a very clear real estate pattern, 14 years up, 4 down. Australia basically follows that. Now, of course, Australia, because it's not really big enough to affect world markets as such, so because we're a much smaller market, Australia can at times be influenced by what might be greater things. We saw that perhaps in 2009, 10, 11 and 12, where the commodities were still being bought by the Chinese. Now, without trying to get too complicated, and the book does show, if you can keep that simple, that easy premise in mind of 14 years up, 4 down, based in the US, it gives you a great, absolutely fantastic theoretical framework in which to view current events, if that makes any sense, yes? Yeah. And so, but what I've managed to do over the years, unlike what most other groups tend to do, you tend to find that people either specialise in real estate or they specialise in stock markets. But the research I tried to do was to bring both together and to see how they both react. Now, of course, stock markets, they're heavily influenced by real estate in the sense that there are, of course, the banks and the real estate trusts and real estate investment trusts and the property companies that are all listed. They are, of course, influenced by what's happening in the real estate market. So the two I find very, very, whilst they can be independent, they're also codependent. And why you want to start to add them together is because at the two extremes, so if we talk about the extremes, the depth of the depression, so that was back in, say, 2008, 2009, 2010, if you can understand how the stock market works, the stock market will bottom first and start recovering long before the real estate market. And indeed, if you can follow that further, the recovery of the stock market is actually telling you, it's leading things. It's telling you that the real estate market will recover eventually. At the tops, so as we go, it's quite easy to get the bottoms of 2012. You add 14 years up, it's 2026 to the next extreme top. As we go into 2026, the framework of reference that I use, you'd find that probably the building companies, the land market usually peaks first at the top of the market, and then the stock market peaks after that because it's still got all the earnings yet to build in. Then we're ready for the downturn. So at the moment, it's what I would call we're ready for that mid-cycle pause.
Right.
If you like, that makes any sense.
No, that's very interesting. So what you're actually saying is, because of course markets are down, we're in bear market territory just at the moment. But what you're saying is, this is not effectively the big down. This is effectively a mid-cycle movement, and it will probably go up further. And I guess my question then is, it's triggered, of course, by the virus, which probably was not something that is predictable, or is it predictable?
Well, that's a good question. Now we start to get into a couple of issues. The framework, the reference I use, 14 years up, 4 down, punctured in the middle by some sort of mid-cycle slowdown. Now, I don't want anybody to misunderstand me. I'm not at all suggesting that I could forecast, for example, that you might go to Brunswick Street, Melbourne tomorrow and you break your leg and you'll be in hospital for 2 weeks. I'm not talking about that type of forecasting. However, the economy does have a structure. It's based on what I call the enclosure of the economic rent. That's the locational value being enclosed and tradable. Because we have that system, it makes the economic system somewhat predictable in the sense that it will move according to a fairly basic framework of people chasing that rent. When that's the case, history showed, and let's say we're dealing just a couple of years ago, where all the talks I've done and everything else, history shows that from the lows, so they were about, say the lows at 2012, you're going to get 7 years up, roughly. So that's going to take you to 2019. Now, if you trace that back in history, we've always had that 7 years up off the initial lows, and then when markets, they've had a very good, solid bull run. We've had a lot of credit created. The banks are starting to do well again. There has been, historically, and you can see this back 200 years in the United States, there has then been some sort of event. I've got absolutely no idea what that event might be, but there's just always been some sort of event that turns the greed to fear. Yes? Now, every cycle's the same but different. What I mean by that is the prior cycle we had the introduction of free floating exchange rates. That was the first. So it's going to make every cycle different. Obviously, they can't all repeat the same. Otherwise, we'd all see it. But if you just do this on a sort of like a seemingly a time type of reference, because the current cycle, the current 14 years up, we now have pretty much the whole world involved, certainly China and even now India. The event that has to turn the world from greed to fear has to be pretty big to actually make that happen. And so, whilst I had no idea that coronavirus, no idea that there was some virus coming, but I do believe, based on the theoretical framework, and I detail this in the Secret Life of Real Estate and Banking in the book, you can be prepared for that type of scenario. And it just, from the things I look at, it was just time for the world to have a pause. It's just as simple as that. Now, generally, the pause goes about a year and a half. Now, you can add to that if you work out, let's say, dealing now with the stock market as distinct from the real estate market. If you have a look at the stock market in the United States, you find a very interesting pattern. And now we're not talking 14 years up, 4 down. Just for the stock market, we're talking say from a decade point of view, years 0 through to 9. There's also quite a distinct pattern in the Dow, where you get mostly the Dow and US markets are often, not religiously like that, but they're often having their recessionary lows in a year ended in one. It just seems that pattern just seems to work out. And it goes back, Martin, it goes back a long way, several hundred years. And now, again, all this stuff coming out, I can tell you that my subscribers, they were ready. They were mostly ready for the type of events that were coming along. And I just find it myself, it's a fascinating way to actually look at the economic system from a time perspective and from those historical patterns. And as you know, I'm sure you know from economics background and things, they don't, with all the modelling that they do in the mathematics, the history gets lost. And once you start to see that history, you can see some such interesting patterns coming out. Now it's fantastic to look at, I find.
Very interesting. So basically what you're saying is that you've got a sense of where we are on that trajectory, and therefore you were able to essentially warn your subscribers of events which were looking likely to happen ahead of time. So they've actually been well positioned.
One of the hardest things I've found to do over the years I've been running the service that I do for people is trying to get them to see the likelihood of a bear market in an absolutely rampaging bull.
Yep.
It's just very difficult to do. And unless you've got that grasp of history, unless you've read some history, and also, unless you can sort of get some framework of reference, it becomes very hard to see. Of course, and I'm not saying it's easy, because you'll be 2017, 18, you're dealing with all your friends, you're talking with everybody that your best mate can say, oh, look, I just bought this house down the road. I've got an absolute bargain. I know it's going to go up for the next 5 years. I'm going to make $1 million. It's very hard to deal with when all your friends are doing that, and all you're seeing is money here and there, and everything's going up. It's very hard to see that there could be a turn. And I've been very thankful with the research I've done with the book. It just gives you that perspective to know that some years are going to be down years. Most of the years are going to be up years, and you can get that perspective of when it happens. I know, people I talk with over the years, I know it gets hard for some people to see, and these spruikers and forecasters, they can be a dime a dozen, and I'm sure you've seen plenty. So, it's hard to differentiate amongst all that, but there are. I would impress upon your viewers, there are patterns, and you can see these things. Just to say again, I've got no idea what's going to happen tomorrow, but there is a rhythm. There's a rhythm that you can see in economics, and it's based very much on real estate, even more so on the land market. And the traditional economists, they do not put land in their models. They're never going to see this. They're just never going to see it.
Very interesting. Now, a question then is, you've got effectively the predictability of the modelling and those cycles, and then you've got market psychology, which runs from bull to bear, and at the moment we are seeing everybody sort of running to the exits, as it were. So, do you find that the market psychology reinforces those cycles, or does it sort of counter against them?
Oh gosh, I think actually it's getting a little worse, if that's possible. American history, and I devoted a few chapters in the book to talk about American history. I found it absolutely entertaining, interesting, fabulous to look at, and I'm sure you've probably done some yourself. I mean, American history is just, they've got so much history. It is incredible. And of course, you know, in the early days of American civilization, the further inland the settlers got, the better the land became, which of course everybody fought for. But it gave some unbelievable stories and history about what the Americans did. Once you can see that, you know, it gives you that framework. And what stood out is some of the utter stupidity that happened at emotional peaks and mid-cycle things. And one of the things, just to give you a real live example of the sort of emotion that you can use to judge where we are in the cycle. Now, I was suggesting, I've been saying this for a long time, and it became, once Mr. Trump had been in office for about a year or so, once we sort of just started to work out some of his patterns, and you know, his real estate background and his emotional ups and downs that he seems to go through. From 2012, the basic model, the real estate, the land movement was suggesting, and I've been saying this for ages. You take the bottom, 2012, and you know, we're talking about emotions and everything else. Basic 7 years up. That took you to a rough estimate of somewhere around 2019 to be getting good high stock prices. Now, I was saying to all my subscribers, if that this is a few years ago, if that happens, then you have to watch. What you've got to look for, somewhere going into the end of 2019, it could even be early 2020, somebody's going to stand up and say that they've ended the business cycle. Now, I don't know if you saw it, but Ray Dalio, his offsider, came out and said that, what do you say, the governments or the banks have ended the business cycle for good. And then, of course, Donald Trump himself stood up. I think it was, I had a feeling he might have ended up doing this in the State of the Union, but he did it at Davos, I think, did he not? He said that he created the best economy in the world, that if you followed him, you know, it would be perpetual up for absolutely forever. Now, those emotions telling you where we are, yes? But of course, unless you've got some sort of model, some sort of framework of history in which to judge that, you're just not going to know. It's going to go right over your head. And what was fantastic for me to watch, Mr. Trump, bless his heart, what was fantastic for me to watch, he has created a cult. He's created a group think. Now, I happen to basically think that most people make rational decisions based on their self-interest. I think this is fairly sensible. But Martin, as I'm absolutely certain you know, in a crowd, we just all lose our head. We just seem to go mental. And Donald Trump, bless him, he created this absolutely enormous crowd behaviour group that, like the lemmings, he could lead them off a cliff, and they'd all follow him. Absolutely incredible. Emotional, yes, emotional. Now, the world now is it's both a big place and a small place, but it's just got more and more emotion. And of course, it's being fed by Facebook, it's being fed by Amazon, it's being fed by all those big things. And now you're starting to see the groupthink played out on a national stage. And it's being fed by these algorithms and everything else that we're as you know, the algorithms are feeding back to you what it is you want to hear. So it's just this bubble that just ends up going in. Now you're seeing that emotion played out. What I'm suggesting, what I put in my book, that sort of thing has a time frame. It's got a reference, and you can put that into a 14 years up, 4 down. It's a fantastic way to see the world. That's what I tried to show. Well, Martin, on page 360 of the book, I give people a clock. It shows what happens within that 14 years up, 4 down. It's just the model. It's not a model. It is actually what happens. And as you go around the clock, it helps you find out roughly where we are and what's coming next. So at the moment, it's 11 o'clock on the clock. That's the mid-cycle slowdown. It just takes about a year to go forward, and then we recover and we just go from there.
Very interesting. Now, that means that we've got to look ahead, right? So, is it what, 2026? Is that the next bottom?
Yes. What I can see happening from here, and I'm not trying to say I've got some magical crystal ball.
Oh.
I mean, clearly, if I had some magical crystal ball that told me what was going to happen tomorrow, Martin, I'd be on a beach in Thailand with 72 virgins. Don't get me wrong. Okay, so I'm not saying I've got that, but within the structure thereabouts, and following on from what history would suggest, and this is probably a serious matter now. What I would see, what wouldn't be uncommon now, is for the Fed, for the governments, they'll do everything possible, and they are doing everything possible. They're gonna create a lot of infrastructure spending. The Fed, other banks, they'll lower interest rates if they continue to do it. I never have seen negative interest rates, but they're going to go low. They'll do all those things. Now, here's the fundamental thing that nobody sees: the mid-cycle slowdowns usually don't involve land value. And so if land prices don't come down, it doesn't put the banks in a difficult position. That being the case, so in about a year and a half's time, the central bankers, they'll have their meeting again in Davos, and the governments, they'll all get together and they'll pat themselves on the back for having averted yet again another worldwide crisis simply by doing the things that usually work: lower interest rates, massive spending. But of course, that creates enormous debts. What it does, it sets us up for the second half of the real estate cycle. Traditionally, historically, if you look at history, the second half of every real estate cycle has been much stronger, more speculation than the first half. And the setup's coming. You'll have central bankers patting themselves all over the place. Everywhere you can see them saying, "We've got it under control. We've done it. We've solved things. We can now look forward. The coronavirus, we've got the vaccine, everything else, whatever they might do." And the bankers will all say absolutely wonderful. And then that's your setup into the second half. And once we had 14 years up, when land price goes right over the top. And the other thing that'll come in, the second half of the cycle, should history repeat, all of the tech stocks will become bankers. They'll go into the real estate market. They'll start creating methods and systems whereby you can get credit, and we'll find ways to be able to afford an ever-increasing land price, and then things really go over the top. And that's extreme. But because people will look back at the prior downturn, which didn't involve land value, which was reasonably easy to fix, they won't see the next one coming either. That's what history says. Yes, that's how you can look forward. So, mate, it gives you a bit of a frame. Does it give you a reference? You can sort of, I know from your background, can you see how that's a likely?
Yep. No, well, it's very interesting because I've spoken to a number of people. Harry Dent, for example, is another guy who believes in cycles, different set of cycles, including some sunspot cycles.
Yes.
But the more you look at the data, you more you realise there are definite patterns that do seem to repeat.
Yes.
And I'm amazed that economists just don't seem to see those patterns. So I'm absolutely with you. Yeah.
Yeah. Yes. I can't understand how the economists, they've got to start talking about emotion, psychology, cycles, patterns.
Yep.
I'm not saying that you can get all the answers, but you've just got to start to recognise that they are there.
And I think it's probably, my hypothesis would be that what you're actually encapsulating is a very complex set of relationships which can't be directly expressed mathematically, right? And economists seem to get themselves all caught up in knots in trying to model this mathematically rather than understanding that this is, by definition, a complex system with many interacting elements. They need to stand back, and essentially, if they could stand back, they could then see the landscape. And what you are doing is seeing the landscape.
Yes, yeah, that's a pretty good way to put it. It just helps to get a framework in which you can put all of these things. I'm certainly not going to sit here and say things are easy and simple, but you can get that modelling where you can just see the repeats. Well, let's face it, we all do the same things pretty much all the time. We all got our favourite chairs and our favourite meals and favourite restaurants and things, and we tend to go back to those patterns.
So, Phil, if people want to find out more about your thinking and your philosophy, how do they do that?
Oh, yes. Well, there's a couple of things. First, it's the propertysharemarketeconomics.com. It's just it's a website. It's very easy to find. And if they're interested in history at all, just grab yourself a copy of Secret Life of Real Estate and Banking. It's not a difficult read at all. It's very easy. It gives you a bit of history, but also shows you the theoretical framework. It's good.
Excellent. Well, look, I appreciate your time today. Thank you very much for sharing your perspectives with us. And I'm sure that people will want to find out more. It's a really fascinating way of thinking about things.
Yeah, thanks, Martin. You're very welcome.
Thanks for your time. Cheers.